Most business owners think their loan application gets approved or denied when they hit submit. In reality, that decision often happens long before the application is even finished. I review funding files every week, and I can tell you something most people in business never even realize. Many SBA applicants are effectively dead before a human ever reads the story behind the business. For years, there has been a quiet gatekeeper sitting between entrepreneurs and capital that they need to grow. Most business owners never even knew it existed. It was called the Small Business Scoring Service, or SPSS. This automated scoring model quietly decided whether your SBA approved loan application can move forward. And if you're a business owner, you may have heard this scoring model if you've applied for financing through an SBA approved lender in the past. If your file didn't hit a certain SBSS number, the conversation usually ended right there. But something major just changed. On February 28th, 2026, the government officially sunsetted the SPSS score. That decision removes one of the biggest automated barriers inside the SBA lending system. And if you're a business owner who has ever been told no by a computer before a real conversation even started, this shift matters a lot more than you and most other people will realize. Let me explain the system most business owners never see. For years, entrepreneurs were fighting a system that they can't see. Every time somebody applied for an SBA 7A loan, the SBSS model generated a score between 0 and 300. The score was being built using personal credit, business credit, and financial data pulled from multiple sources that predict whether or not a person's going to be able to pay off their loan. Most lenders required a score around 165 or higher before the file could even move forward to actual underwriting. If the score fell below that threshold, the application usually stopped right there. It didn't matter how strong the business idea or financials were. It didn't matter how hard the owner worked to build that company either. The algorithm flagged the file, and the deal quietly died inside the system. The business owners left wondering, what happened to my application? And they need to then follow up with the bank and get a reason from the bank. That's the reality of automated underwriting models. They're fast, but they're rigid. On March 1st, 2026, that gatekeeper went away. The SBA is now allowing lenders to evaluate smaller SBA 7A loans using their own internal underwriting systems instead of relying on one universal score. Inside the funding world, that is a major shift. It moves the process away from a single robotic filter and back towards real lending conversations and debt service analyses, where lenders can actually look at the full picture of a business. Now, I want to be careful here because a lot of business owners are going to hear this news or heard this news already and immediately assume funding suddenly becomes easy. That's not how lending works, especially with single-digit interest, unsecured, or secured business loans. Banks are still conservative institutions. The bank is the one lending the money. If it's SBA approved, then the SBA is guaranteeing a portion of that money, so the bank still has a lot of risk. That means they're going to still move slowly, and they're going to manage their risk carefully. Even without the SBSS score, lenders are still going to look closely at your credit profile, your cash flow, your debt service, and your financial history. Most SBA approved lenders still want to see a personal credit score around 680 or higher, if of course you want the process to move smoothly. I do see SBA approved lenders approve files as low as 640, 660 scores too, but usually those need collateral or some sort of down payment or really great debt service coverage ratios and cash flow. But now there's a huge difference. The score is not going to be the only thing that matters. Strong revenue trends, cash flow, DSCR, is going to carry a lot more weight moving forward with SBA loans. Another thing that's going to carry more weight is industry stability. So whether or not your industry is a stable industry, has high overhead, high assets, the story behind the business itself is going to carry more weight. Now that a lender can look beyond a single automated score, good businesses that previously fell just outside the algorithm suddenly have a chance to be evaluated properly. And that's awesome for Main Street America. It creates real opportunities for owners who understand how to present their financials clearly and approach the right lenders for them. One of the mistakes I constantly see when reviewing funding files that's worth mentioning right now is that business owners think SBA financing is the only type of capital available. In reality, funding usually happens in stages. There's a ladder. Early stage businesses often start with alternative capital and fintech lenders that offer revenue-based financing, equipment financing, or invoice factoring and working capital lines. As a business grows and the financials stabilize, that capital can eventually graduate into bank lines of credit or SBA financing. Think of it like a funding ladder. One of the things you don't want to do is something I see all the time. It's a mistake that hurts businesses the most. It's stacking short-term capital without a long-term strategy. I see this constantly. A company takes one working capital loan or one cash advance, then another, and before you know it, they're taking money from Peter to pay off Paul, and they're not actually growing their business. They're not even working on their business because they're too worried about where their cash flow is going to come from tomorrow. So they keep taking more money until cash flow becomes a ghost. It becomes very tight. And the business damages its fundability profile in the process of doing this as well. It risks access to good loans in the future. Now, used correctly, alternative financing can act as a bridge to stronger financing options. Used incorrectly, it can delay SBA or conventional financing eligibility for years. That is why capital strategy matters so much. The goal isn't just getting funding today. The goal is positioning the business for better funding tomorrow. There's another opportunity happening right now that very few business owners are talking about, and I want to mention that too. The government is pushing hard to bring manufacturing back to the United States, and SBA programs are being used to support that effort. From October 2025 through September 2026, the SBA is waiving loan fees for certain small manufacturers with employees under the number 500. Normally, these fees would range from 2% to 3.5% of the loan amount. On a loan close to $1 million, that could easily mean $15K or more in upfront costs. Under the current program, these fees drop to zero for qualifying manufacturers borrowing under $950,000. That means more capital stays inside the business instead of going to administrative fees. Programs like the Manufacturers Access to Revolving Credit Initiative are also expanding access to longer-term working capital lines that can remain open for years for these manufacturers to use. For companies building real products, this creates a very meaningful opportunity to invest in equipment, hiring, and production capacity while these incentives are available. If you're a business owner watching this, the smartest thing you can do right now is understand where your business actually stands in the funding ecosystem. My team and I spend our time reviewing funding files and analyzing underwriting decisions across multiple lenders every single day. If you want to know what capital options realistically fits your business today, we can help you figure that out. Below this video, there's a link where you can schedule a funding strategy session with our team. During that call, we'll run a real underwriting review of your file. We'll show you what you qualify for right now, whether SBA financing is realistic for your business now or in the future, as well as what steps would move you closer to stronger capital now or in the future. You'll walk away understanding your funding ladder and the next moves that actually matter. If that sounds helpful, click the link below and schedule moving forward for your business.